At 9:28 a.m., the markets opened, and within minutes, it was clear the trade war had entered a dangerous new phase. What began as another escalation in tariffs quickly transformed into something far more serious. Screens across trading floors turned red, alerts flooded financial networks, and investors scrambled to understand what had just changed. This was no longer a controlled negotiation tactic. It was the moment when pressure crossed a line and began pushing back. The White House had announced a fresh round of aggressive trade measures, targeting key imports with expanded tariffs and signaling that further restrictions could follow. The message was direct: the United States was doubling down. Officials framed the move as a necessary step to protect domestic industries and force better terms from global partners. But markets don't react to messaging, they react to consequences. And the consequences began unfolding immediately. Within the first hour, the Dow Jones Industrial Average dropped sharply, shedding hundreds of points as industrial and multinational companies led the decline. These were the firms most exposed to global trade flows, and investors understood that higher tariffs meant higher costs, disrupted supply chains, and uncertain demand. The S&P 500 followed lower as selling spread across sectors. Even companies not directly tied to trade began to fall, a sign that fear was no longer isolated, it was systemic. The Nasdaq experienced rapid swings as traders reassessed growth expectations in a suddenly unstable environment. Technology companies, often dependent on global manufacturing networks and international markets, faced renewed pressure. This wasn't just about goods crossing borders. It was about the entire system that supports modern business. And that system was being shaken in real time. The immediate trigger for the market shock was not just the U.S. action, it was the response. Within hours, major trading partners signaled retaliation. Canada, China, and other key economies indicated they would not absorb the pressure quietly. Countermeasures were prepared, targeting American exports and industries that rely on global demand. Agricultural products, manufacturing goods, and key industrial sectors suddenly faced the risk of reduced access to foreign markets. The strategy that was supposed to create leverage was now creating resistance. Investors recognized the pattern instantly. Trade wars rarely stay one-sided. They escalate. Each move invites a response, and each response adds another layer of complexity. What begins as a negotiation tool can quickly become a cycle of action and reaction, where control becomes harder to maintain. That is exactly what markets were pricing in. This was no longer a dispute, it was a confrontation. Business leaders reacted with growing concern. Executives warned that rising tariffs would increase production costs, forcing companies to either absorb losses or pass them on to consumers. Supply chains, carefully built over decades, faced disruption. Contracts became uncertain. Planning became difficult. In a stable environment, businesses can adapt to policy changes. But in a volatile environment, adaptation becomes risk, and risk reduces investment. That is how economic slowdowns begin, not with a single event, but with a shift in confidence. Financial analysts began using stronger language as the day progressed. Terms like escalation, systemic risk, and policy miscalculation appeared in reports. Some argued that the administration was underestimating the interconnected nature of the global economy. Others suggested that markets were overreacting to short-term developments. But even those voices acknowledged one reality: uncertainty had increased sharply. And uncertainty is something markets punish quickly. The currency market added another layer to the shock. The U.S. dollar fluctuated as investors balanced safe haven demand against concerns about economic stability. Other currencies moved in response to shifting trade expectations. Commodity-linked currencies reacted to potential changes in global demand. The message was consistent. Across asset classes, everything was being repriced. Bond markets told a similar story. Treasury yields dropped as investors moved into safer assets, signaling a flight from risk. When capital shifts this way, it reflects deeper concern about future growth. Investors were not just reacting to tariffs. They were reacting to the possibility that the trade war could slow the global economy. That possibility was becoming more real with every new headline. The contrast between expectation and reality became clear by midday. The administration had expected pressure to create quick concessions. Instead, it created immediate pushback. Markets, which often act as early warning systems, were signaling that the strategy might not play out as planned. When stocks fall, yields drop, and volatility rises all at once, it is rarely a coincidence. It is a message, and the message was becoming louder. By the closing bell, some losses had stabilized, but the damage was done. Confidence had been shaken. Investors were no longer viewing the situation as a manageable dispute. They were seeing it as a developing economic risk event. The difference between those two perspectives is significant. One can be negotiated, the other can spread. As trading ended, one thing was clear. The trade war had entered a new phase, not defined by policy announcements, but by market reaction. What was meant to demonstrate strength had introduced uncertainty. What was intended to create leverage had triggered resistance. And what was expected to remain contained was beginning to expand. Because in global markets, the first reaction is often the most honest. And on this day, that reaction was unmistakable. At first glance, the strategy looked simple. Apply pressure through tariffs, force trading partners to the table, and secure better terms. Inside Washington, it was framed as leverage an aggressive but necessary move to correct imbalances and protect domestic industries. The assumption was clear. The United States, as the world's largest consumer market, held the advantage. Other countries depended on access to that market, and once that access became more expensive or uncertain, they would have little choice but to concede. But within days of escalation, that assumption began to break down. The strategy didn't fail because pressure was applied. It failed because the system it targeted was far more interconnected than expected, and pressure in an interconnected system does not move in only one direction. The first sign of collapse came through retaliation. Major trading partners did not respond with compromise. They responded with countermeasures. Tariffs were matched, restrictions mirrored, and new barriers introduced against American exports. Agricultural products, industrial goods, and manufacturing outputs quickly became targets. What Washington had expected to be a one-sided application of leverage turned into a two-sided confrontation. And once that happened, the original advantage began to weaken. Because in a trade war, every move creates a response, and every response creates new costs. The second problem was domestic impact. Tariffs are often presented as penalties on foreign producers, but in reality, they function as taxes within the domestic economy. When imported goods become more expensive, American companies that rely on those goods face higher costs. Manufacturers pay more for raw materials and components. Retailers pay more for inventory. Those costs are either absorbed, reducing profits, or passed on to consumers, raising prices. Either way, the pressure does not stay external. It flows inward. Businesses began to feel that pressure almost immediately. Supply chains, built for efficiency over decades, were suddenly disrupted. Contracts had to be renegotiated. Sourcing strategies had to change. And in many cases, alternatives were not readily available. That kind of disruption creates friction. And friction slows growth. Export markets added another layer of damage. As other countries imposed their own tariffs, American products became less competitive abroad. Farmers saw reduced demand for crops. Manufacturers faced shrinking order books. Companies that depended on global sales began revising forecasts downward. This was not theoretical. It was measurable. Orders slowed, inventories increased, prices adjusted. The very industries the policy aimed to protect were now facing new challenges from reduced access to international markets. This is the paradox of trade wars. Protection in one area often creates vulnerability in another. Investor confidence began to erode as these realities became clear. Markets are forward-looking. They do not wait for full economic data to confirm trends. They react to signals. And the signals were becoming increasingly negative. Rising costs, shrinking exports, supply chain disruption, and retaliatory policies all pointed in the same direction: uncertainty. And uncertainty is one of the most powerful forces in financial systems. When investors cannot predict outcomes, they reduce risk. They delay investment. They move capital into safer assets. That behavior slows economic activity even further. It becomes self-reinforcing. Another critical flaw in the strategy was the assumption that alternatives were limited. The belief was that trading partners, particularly smaller economies, would have no choice but to rely on U.S. markets. But that assumption underestimated the adaptability of global trade networks. Countries began exploring new partnerships, diversifying supply chains, and strengthening regional agreements. What might have taken years under normal conditions began accelerating rapidly under pressure. Once alternatives start forming, leverage declines. And once those alternatives become established, they are difficult to reverse. The strategy did not just create short-term tension, it risked long-term structural change. There was also a communication problem. Markets and partners were not always clear on the end goal. Was the objective to reduce trade deficits, restructure agreements, protect specific industries, or apply political pressure? When goals appear inconsistent or shifting, confidence weakens. Businesses cannot plan effectively without clarity. investors cannot allocate capital with confidence, and partners cannot negotiate efficiently if the target keeps moving. Strategy requires not just action, but coherence, and coherence was becoming harder to identify. As the situation evolved, analysts began reframing the entire approach. What was initially described as leverage started to look like escalation without a defined endpoint. The longer the conflict continued, the more costs accumulated on all sides. And unlike short-term policy adjustments, trade wars have a way of embedding themselves into economic systems. Contracts change, supply chains shift, relationships evolve. Even if tensions ease later, the original structure may not fully return. That is what makes such strategies risky. They do not just affect the present, they reshape the future. By the time markets fully processed these factors, the narrative had changed. This was no longer a story about strength and negotiation. It was a story about unintended consequences. The strategy was built on the idea that pressure would produce quick results. Instead, it produced resistance, disruption, and uncertainty. The pressure that was meant to move outward began moving inward. And once that shift happens, the cost of continuing the strategy rises significantly. In the end, the collapse was not sudden, it was progressive. Each reaction exposed another weakness. Each countermeasure reduced leverage. Each market movement signaled growing doubt. And as those signals accumulated, the foundation of the strategy began to erode, because in a global economy, power is not just about size, it is about balance. And when that balance is miscalculated, even the strongest strategies can begin to fall apart. As the trade war escalated and markets struggled to find stability, one voice, the financial world always listens to, finally broke the silence. Warren Buffett, known for his calm, long-term perspective and decades of market experience, stepped into the conversation, and within minutes, his words began reshaping the narrative. Because when volatility rises and uncertainty spreads, investors don't just look at data, they look for judgment. And Buffett's judgment carries weight that few others can match. His reaction did not come through dramatic headlines or emotional statements. It came in a measured, deliberate tone, the kind that often signals deeper concern. Speaking in an interview that quickly circulated across financial networks, Buffett addressed the growing trade conflict with a level of clarity that cut through the noise. He did not focus on short-term market movements. He focused on long-term consequences. And that distinction mattered. Because while markets were reacting minute by minute, Buffett was looking at what the situation could become if it continued. He began with a simple but powerful observation. Trade wars are complex, and they rarely produce clear winners. That statement alone challenged the dominant political framing. While policymakers spoke in terms of leverage and victory, Buffett spoke in terms of systems and outcomes. He explained that modern economies are deeply interconnected, and actions that appear beneficial in isolation can create unintended consequences when viewed across the entire system. It was not a rejection of policy goals, it was a warning about execution. The key message was subtle but unmistakable. Stability matters more than aggression in economic strategy. Buffett emphasized that businesses thrive in predictable environments. They invest, hire, and expand when they can see the future with reasonable clarity. But when policies shift rapidly and conflicts escalate unpredictably, that clarity disappears. And when clarity disappears, so does confidence. This was not theoretical. It was already visible in market behavior. Volatility was rising. Investment decisions were being delayed. Capital was moving more cautiously. Buffett was describing a pattern that experienced investors recognize immediately. He also addressed the idea of pressure as a negotiating tool. While acknowledging that countries have the right to protect their interests, he pointed out that pressure can produce resistance rather than cooperation. In a global economy, other nations are not passive participants. They adapt, they respond, they find alternatives. And when they do, the original leverage weakens. This was exactly what markets were beginning to reflect. Retaliation was spreading, supply chains were shifting, and the assumption of one-sided advantage was being challenged. One of the most impactful parts of his remarks focused on uncertainty. Buffett has often said that markets can handle bad news better than unclear news. In this case, the issue was not just tariffs or trade balances, it was the unpredictability of what might come next. Would tariffs increase further? Would new sectors be targeted? Would agreements be reached or abandoned? Each unanswered question added another layer of risk. And risk, when it cannot be measured, becomes fear. That fear was already influencing behavior across financial markets. The media response was immediate and intense. Financial networks replayed his comments repeatedly. Analysts dissected every sentence, Headlines emphasized his caution. The reason was simple. Buffett rarely speaks in alarmist terms. When he raises concerns, it signals that the issue has moved beyond routine volatility. His reputation is built on long-term thinking, disciplined analysis, and an ability to remain steady during market swings. So when he highlights risk, people listen differently. His words do not create panic, but they do create attention. Investors began adjusting their expectations almost immediately. Some saw his comments as confirmation that the trade war could have deeper economic consequences than initially assumed. Others viewed it as a reminder to focus on fundamentals rather than short-term noise. But regardless of interpretation, the effect was the same. The conversation shifted. It was no longer just about tariffs and retaliation. It was about confidence, stability, and the broader direction of the global economy. Inside Washington, the reaction was more complicated. Officials defended their strategy, emphasizing the need to address trade imbalances and protect domestic industries. But Buffett's comments added pressure, not political pressure, but credibility pressure. When a figure with his track record questions the potential outcomes of a strategy, it forces a reassessment, even if that reassessment happens quietly. Policymakers may not change course immediately, but they cannot ignore the signal. Business leaders echoed many of his concerns. CEOs and executives, already dealing with rising costs and uncertain supply chains, pointed to Buffett's remarks as validation of what they were experiencing. Planning had become more difficult. Forecasting had become less reliable. Decisions that would normally be straightforward now carried additional risk. In that environment, caution becomes the default. And when businesses become cautious, economic momentum slows. By the end of the day, Buffett's intervention had achieved something significant. He had reframed the situation without escalating it. He had introduced perspective without adding panic. And most importantly, he had reminded both markets and policymakers of a fundamental truth. Economic systems are not easily controlled once they are set in motion. The trade war was no longer just a policy debate. It was a test of how much uncertainty the system could absorb. And as his words continued to circulate, one thing became clear. The world was not just watching the trade war. It was listening to the warning behind it. The moment Warren Buffett's warning hit the airwaves, Wall Street didn't wait. It reacted, fast, decisive, and unforgiving. Because in financial markets, timing is everything, and when a voice like Buffett signals concern during an already fragile moment, investors don't debate for long. They move. Within minutes of his comments spreading across trading desks, the tone of the market shifted from cautious volatility to something more serious. This was no longer just a reaction to trade headlines. It was a reaction to credibility risk. The Dow Jones Industrial Average, already under pressure, extended its losses sharply. Selling accelerated in industrial and multinational stocks, the very companies most exposed to global trade flows. These firms depend on predictable supply chains, stable export markets, and clear policy direction. When those conditions disappear, their valuations come under immediate scrutiny. Investors began reducing exposure, not because earnings had collapsed overnight, but because the future had become harder to price. And in markets, uncertainty is often treated as risk even before it becomes reality. The S&P 500 followed the same pattern, with broad-based declines across multiple sectors. What made this reaction more significant was its reach. It wasn't limited to companies directly tied to trade. Financials, consumer stocks, and even some defensive sectors saw pressure. That kind of movement signals something deeper. It means investors are no longer isolating the problem, they are expanding it. When a localized issue becomes systemic in perception, selling spreads. And once selling spreads, it feeds on itself. The Nasdaq told a slightly different but equally important story. Technology stocks, which often trade on future growth expectations, experienced sharp swings throughout the session. Some names dropped quickly as investors reassessed global demand and supply chain exposure. Others showed brief resilience before being pulled lower by overall market sentiment. The volatility itself became the signal. Markets were no longer confident in their assumptions. And when assumptions break down, price discovery becomes unstable. Bond markets reinforce the message. Treasury yields dropped as investors moved capital into safer assets. This kind of shift is often described as a flight to safety, but it carries a deeper meaning. It reflects a change in mindset. Investors are no longer focused on maximizing returns. They are focused on protecting capital. That transition does not happen lightly. It happens when confidence begins to weaken. And Buffett's comments, combined with escalating trade tensions, were clearly accelerating that shift. The US dollar fluctuated as traders balanced competing forces. On one side, it remained a traditional safe haven during global uncertainty. On the other, the trade conflict itself was tied to US policy, creating a layer of caution. Currency markets often capture nuance that equity markets do not. And in this case, the nuance was clear. Confidence was not collapsing, but it was being questioned. That distinction matters, because once questioning turns into doubt, movements become more aggressive. Sector-level reactions revealed the full scope of the impact. Manufacturing stocks were among the hardest hit, reflecting concerns about rising input costs and disrupted supply chains. Agricultural companies faced pressure due to potential export losses. Retailers worried about higher import prices and reduced consumer spending. Even financial institutions, which benefit from economic activity, saw declines as growth expectations were revised downward. The only relative strength appeared in defensive sectors and safe haven assets, but even there, gains were measured rather than confident. Analysts across Wall Street began revising their outlooks almost in real time. Reports highlighted the growing disconnect between policy expectations and market reality. Some pointed directly to Buffett's warning as a turning point, not because it introduced new information, but because it validated existing concerns. Markets had already been uneasy. His comments gave that unease a voice. And once concerns are voiced by someone with credibility, they tend to spread faster. A familiar insight began circulating again, one often associated with Buffett's philosophy. Markets can handle bad policy. They can adjust, adapt, and recover. But what they struggle with is uncertainty about the rules themselves. If businesses cannot predict the environment they are operating in, they cannot plan effectively. And if they cannot plan, they cannot grow. That is the kind of uncertainty that drives sustained market weakness. The contrast between before and after his comments was striking. Before, the trade war was seen as a risk, but one that might be managed or negotiated. After, it began to look like a structural problem with broader implications. That shift in perception is critical. Markets are not just driven by events, they are driven by how those events are interpreted. And once interpretation changes, price follows. By the closing bell, the numbers told the story clearly. Losses across major indices, declining yields, volatile currencies, and shifting sector performance all pointed in the same direction. Confidence had taken a hit. Not a collapse, but a noticeable, measurable decline. And in financial systems, confidence is everything. It influences investment, spending, hiring, and growth. When it weakens, the effects spread far beyond the trading floor. What made this moment different was not just the market reaction, it was the reason behind it. This was not a reaction to a single policy move or economic report. It was a reaction to a growing realization that the trade war might not follow a predictable path, that it could escalate, expand, and persist in ways that are difficult to control. And when that realization takes hold, markets do what they always do. They adjust first and ask questions later.